Monica Fan is with me now. She's Senior Currency Product Engineer with State Street Global Advisors. Thanks so much for coming in, Monica. So we saw a sharp euro sell-off on Thursday. Tell me a little bit about the reasons behind all this euro selling.
Well, certainly since the turn of the year, there's been increasing concern about the potential breakup of the euro. Portugal, Spain have all struggled in terms of raising new funds for debt issuances. There will be concern ahead of a slew of 1.25 billion euro of new issuances, how successful they will be. There is also the Belgian premium, with the various political parties still struggling to form a credible government. And of course, S&P and other rating agencies have already warned that the failure to form a government sooner rather than later will certainly prompt a sovereign debt rating downgrade.
Now, we've got Italy, Portugal, other European countries preparing to sell debt next week. Just how much pressure are these debt sales going to put on the euro?
I think they will put a lot of pressure on the euro, as they already have been. We've seen euro trade roughly in a 130 to 135 range since the start of the year. If we see a decisive break below 129, there is the potential for the euro to fall as far as 124 in the short term. That said, if we do see risk within the eurozone being contained credibly, then I do think that the debasement of the US dollar through further quantitative easing will assist the euro to rebound back up to above 135 later in the year.
At what point in the year are we looking at 135 potentially?
I think we will have to wait at least until the late second quarter.
And when you say 124 in the short term, you're talking about the next...
Over the next 3 months.
Over the next 3 months.
Yeah.
According to BNP Paribas, Spain and Italy together need to raise, what, 317 billion euros or $413 billion this year. Just how much of a struggle is that going to be?
It will be a struggle, particularly with growing concerns about investors having to incur haircuts on sovereigns, and the package about the European financial stability package that kicks in 2013 not being finalised. That said, you've actually had very positive comments from Chinese government officials saying that they will support the Eurozone and the euro through purchases of European government bonds.
Does that actually do anything to boost demand for European bonds? I mean, there isn't actually any data as to just how extensive Chinese holdings are in European debt, right? There's no evidence to support what they're saying.
Well, it's certainly the case that there has been a reduction out of euros in terms of diversification in the last quarterly survey from the IMF, from their COFA survey. That said, I think that's been more of a case of passive rebalancing, and currencies are very much a relative value trade. It's a case of which is the more, or in this case, it seems, the less attractive currency, the euro or the US dollar.
Now, Spain, its funding costs perhaps not as severe as Portugal's we were just talking about, but nevertheless, its banks, a cause for concern.
Absolutely. I think the strength of the entire financial structure within the Eurozone remains to be tested.
Great. Monica Fan, thank you so much for coming in. Good to talk to you.